Welcome to part 4 of our financial statements video training. In this video, we focus on property, plant, and equipment, which is a long-term or non-current asset classification on the balance sheet. We discuss the cost of these assets, the related accumulated depreciation, and the resulting book value. Please print the PDF handout shown below this video as it will be used throughout the training.
Excellent. The question is, how do we determine the depreciation on the building? Is there some formula? And I'm going to expand the question to say on any of these assets, because we're going to depreciate equipment and vehicles and furnishings, right? How do we come up with the rate? Is there some formula? Do we look for guidance? Well, the accountants work on principles, and we don't have any specific notations or specific years for any asset. On the other hand, the Internal Revenue Service does. The Internal Revenue Service on your tax return will tell you exactly what to do. But on our financial statements, to answer your question, on the financial statements here, we're driven by the matching principle. And the matching principle says, spread that cost over all the periods that will be benefiting from that. And so we say, well, how long will the asset be benefiting us? Not how long will the asset last. How long will the asset be useful for our business and what we do? So if I'm a graphics design person and I buy a really high-powered fancy computer and let's say it's $3,000, I might depreciate that $3,000 computer over 2 years on my financial statements, because in my business I need the state-of-the-art software, and the software wants more hardware, and so my machine might only be useful to me as a design person for 2 years. Now if I, on the other hand, as an accountant, buy a $3,000 computer today, I might be able to use it for 6 years, 7 years. What do we do in accounting? Nothing quite that powerful, right? We just move numbers around and print stuff out. So the useful life of a computer for an accountant is different than the useful life of a design person, where the software demands new technology continuously. Accounting doesn't demand that kind of technology. Okay? So the same for the building. How long is the building going to be useful to us? So we might say, well, 25 years, let's use, right? And then over at the IRS, they'll tell you what to do on the tax return. So it's important to note here that we're talking the depreciation for the books, for the financial statements, and that will be different than what's going to be on the tax return. And so people always used to kid, oh, you keep 2 sets of books. You have to. You got to comply with the Internal Revenue regulations. You can't go off course from their regulations. On the other hand, we're trying to measure profitability. So when we do depreciate these, the expense is actually going to an income statement, and we don't want to distort that income statement. Right? So today maybe the IRS says, write it off instantly if you want. We want to stimulate the economy. Great, do it. But over here, we don't want to write off a $100,000 piece of equipment in 1 month on our income statement and blow the financial statements out of the water. Right? So we're going to have 2 records for depreciation, the tax records and the